GameStop.
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 GameStop's stock is surging.
Retail investors beat Wall Street, so Wall Street changed the rules. On Wall Street, profit comes before consequences. And hedge funds, they smell blood in the water like sharks. When a company starts failing or edges toward bankruptcy, they don't run from it, they circle it. They bet on its collapse. They short the stock, aiming to profit from the downfall. That's exactly what happened with GameStop. A struggling video game retailer Wall Street had already declared dead. But this time, the sharks weren't alone in the water. A guy calling himself Deep Fucking Value turned $53,000 into $48 million, betting on a company Wall Street had written off. This wasn't about one trader winning, it was about how fragile the system already was. Somehow, retail investors, ordinary people on Reddit armed with memes and trading apps, brought the financial system to its knees. This wasn't just a story about making money, it was David versus Goliath, the internet versus institutional power, the people versus Wall Street. This is the Wall Street Files, the story of how retail investors nearly beat the stock market, until the big guys on Wall Street rigged the rules and hit pause on the GameStop revolution. Let's go back to 2019. GameStop was dying, and everyone knew it. But before that, it was a household name. GameStop was the go-to store for gamers. You'd walk into the mall, trade in your old PlayStation or Xbox games, and get a few bucks in store credit. Then you'd browse the shelves for the latest titles, consoles, or accessories. At its peak, GameStop had thousands of stores across the US and dominated the physical video game retail market. It made billions selling new and used games, hardware, and collectibles. But the gaming world changed quickly. Digital downloads replaced physical discs. Gamers started buying directly from online platforms like Steam, Xbox Live, and the PlayStation Store. GameStop couldn't keep up. Its business model, built on physical retail and secondhand games, was collapsing. Sales dropped. Stores closed. The company started bleeding money. GameStop became a relic. Empty stores, declining revenue, and a stock price that had crashed from $60 to under $4. By 2019, Wall Street had made up its mind. GameStop was a dinosaur headed for extinction. Naturally, Wall Street saw an opportunity. GameStop looked like a company that was going to fail, so hedge funds tried to make money from its downfall. They did this by shorting the stock. Short selling is when you borrow shares of a company and sell them right away, hoping the price will go down. Later, you buy the shares back at the lower price, return them to the lender, and keep the difference as profit. So, if you short a stock at $10 and it drops to $5, you make $5 per share. But if the stock goes up instead, you lose money. And there's no limit to how much you can lose. With GameStop, hedge funds went all in. They didn't just short a few shares, they shorted more shares than actually existed. By January 2021, over 140% of GameStop's shares were sold short. That means some shares were borrowed and sold multiple times. They were so confident GameStop would crash, they made massive bets, even on shares that technically weren't there. But there was this one guy, Keith Gill, a 34-year-old financial analyst from Massachusetts. He went by Roaring Kitty on YouTube and Deep Fucking Value on Reddit. Everyone thought GameStop was dead, but Gill saw something different. He dug into the numbers and realized GameStop wasn't actually going bankrupt. The company still had cash in the bank, owned valuable real estate, had a loyal customer base, and most importantly, it was starting to shift toward an e-commerce model. Plus, with new gaming consoles launching, people were going to need somewhere to buy games and accessories. But here's where it got really interesting. Gill noticed the insane short interest. Over 140% of available shares had been sold short. That's not just risky, that's a powder keg. If enough people started buying the stock, the price would shoot up, and the hedge funds would be forced to buy back at higher and higher prices. That's a short squeeze, and it can be explosive. So in 2019, Keith Gill took a chance and put his money on GameStop. He invested his life savings around $53,000 into GameStop stock and call options. Now, a call option is basically a bet that a stock will go up in price. It gives you the right, but not the obligation, to buy a stock at a certain price, called the strike price, before a certain date. So if you think a $10 stock will go to $20, a call option lets you lock in that $10 price. If you're right, you can make a lot more money than just buying the stock, because options cost much less upfront and multiply your gains. But here's the catch. If the stock doesn't go up enough, or goes down, that option becomes worthless. You lose the entire amount you paid for it. It's a high-risk, high-reward move, and Keith Gill was all in. Then he started posting about it on Reddit. RR Wall Street Bets was this wild corner of the internet where people shared screenshots of massive wins and brutal losses, called each other degenerates, and threw around terms like diamond hands, tendies, and YOLO. It wasn't exactly serious financial analysis, more like a mix of a gambling addiction support group and a frat house. But Keith Gill's posts stood out. Every week, he'd share updates on his GameStop position, screenshots of his gains, his losses, and most importantly, his unshakable belief that this trade was going to work. People started paying attention, they called him a legend, and then they started following his trades. He explained that if enough people started buying GameStop stock, it could trigger something called a short squeeze. This is where Wall Street's risk turned into a trap. When you short a stock, you're borrowing shares and selling them right away, hoping the price goes down. Then you buy the stock back at a lower price, return the shares, and keep the difference as profit. But here's the catch. If the stock price goes up instead of down, you start losing money fast. And those losses? They're unlimited. If you short a stock at $10 and it jumps to $100, you've lost $90 per share. If it skyrockets to $1,000, you've lost $990 per share. Eventually, short sellers panic. They rush to buy back the stock to cut their losses, but that sudden buying pushes the price even higher, which triggers more panic and even more buying. It creates a vicious cycle, a feedback loop that sends the stock price into the stratosphere. And with GameStop, that's exactly what was about to happen. And with GameStop being 140% shorted, Gill realized something huge. If they could just get the buying started, the short sellers would be forced to buy back more shares than actually existed. It had the potential to become the mother of all short squeezes. So throughout 2020, more and more people on Wall Street Bets on Reddit started running the numbers. If hedge funds were betting this heavily against GameStop, and if enough regular people bought and held the stock, they could trigger a squeeze so violent, it could make those hedge funds lose billions. It wasn't just a trade anymore, it was a movement. Then came Ryan Cohen. The billionaire who built Chewy into a pet food empire saw something in GameStop. In late 2020, he bought a massive stake and pushed to join the board, bringing serious e-commerce expertise with him. Suddenly, Gill's thesis didn't sound so crazy anymore. Maybe GameStop wasn't doomed. Maybe this so-called dying company actually had a future. The stock started creeping up, from $4 to $10, then to $20. But the hedge funds didn't get the memo. They kept shorting. Melvin Capital, run by Gabe Plotkin, had bet hundreds of millions that GameStop would crash. The higher the stock climbed, the more money they lost, but instead of backing off, they doubled down. Meanwhile, Wall Street Bets was evolving. It wasn't just about making money anymore. It had become personal. They'd watched wealth inequality explode while hedge funds got richer. To them, GameStop wasn't just a stock. It was a symbol, a chance to fight back, to turn the tables, to make Wall Street bleed for once. Then came January 11th, GameStop officially announced that Ryan Cohen was joining the board. The stock jumped 50% in a single day. The price kept climbing from $40 to $60, then all the way to $100. Each milestone brought more attention, more buyers, and more FOMO. Financial news networks, many of which had never even heard of Wall Street Bets, were suddenly trying to explain what diamond hands meant on national television. Then Elon Musk threw gasoline on the fire. On January 26th, he tweeted a single word, GameStop, along with a link to r/Wall Street Bets. The stock doubled overnight. By January 27th, GameStop hit $347 a share. The hedge funds were bleeding cash. Melvin Capital had lost over 30% of its value in just a few weeks. They were so deep underwater, they needed a $2.7 billion bailout from Citadel just to stay alive. But here's the best part. Regular people were winning. Keith Gill's original $53,000 investment, now worth over $40 million. Thousands of retail traders, most of whom had never made more than a few $100, were suddenly staring at life-changing money. For one brief moment, it felt like David was actually beating Goliath. But Wall Street money? That's not so easy to beat. On January 27th, Reddit's infamous subreddit r/Wall Street Bets and its Discord server was banned due to violations of the platform's restrictions on hateful speech and discriminatory content. But the timing was suspicious. The momentum shifted. Then came January 28th, the day that exposed just how rigged the game really was. GameStop opened in pre-market trading at over $500. Reddit was flooded with screenshots of massive gains. Retail investors were on fire. But at 9:30 a.m., when the market officially opened, something strange happened. Robinhood, the trading app used by millions of small investors, suddenly announced that you could no longer buy GameStop stock. You could only sell. This hit hard because Robinhood was the go-to app for retail traders. It made stock trading easy, fun, and free. With no commissions, no account minimums, and a sleek mobile interface, it had become the platform of choice for first-time investors. And right there, in the middle of a short squeeze where the entire strategy depends on people buying and holding, Robinhood just turned off the buy button. It felt like the rules had been rewritten in real time. If hedge funds could short a stock into the ground, why couldn't regular people buy it back up? Robinhood claimed it was a technical issue, that they didn't have enough capital to meet clearinghouse requirements. But people started asking questions. Like why Citadel, the same company that had just bailed out Melvin Capital, also happened to be Robinhood's biggest source of revenue through something called payment for order flow. Here's how that works. Robinhood doesn't charge users a commission to trade. Instead, it makes money by selling your trade orders to big firms like Citadel. Those firms execute the trades, and in doing so, get early access to valuable information about what retail traders are buying or selling. It's legal, but many argue it gives firms like Citadel an unfair edge, allowing them to profit from retail investor activity. So people started connecting the dots. Citadel was losing money on GameStop. Citadel pays Robinhood. And suddenly, Robinhood stops people from buying GameStop? It didn't look good. Whether it was incompetence or protection didn't matter. The effect was the same. Buying stopped, and hedge funds got time. Without buying pressure, GameStop's price collapsed. From over $500 to under $200 in a single day, millions of people who thought they were about to change their lives watched their gains disappear, just like that. What started as a Reddit adventure had now burst into the world of politics. People from both parties were outraged. Alexandria Ocasio-Cortez and Ted Cruz, who agree on almost nothing, both condemned Robinhood's actions. Representative Maxine Waters announced that Congress would hold hearings, and they did. Keith Gill testified that he'd done his own research, believed in GameStop's potential, and never told anyone else what to buy or sell. He came off calm, intelligent, and genuine. The hedge fund guys tried to paint themselves as victims. Gabe Plotkin from Melvin Capital said he received anti-Semitic attacks and death threats, which, if true, is terrible. But it was hard for the public to feel sympathy for a man who lost billions betting against a company, only to get bailed out by even richer friends. Meanwhile, Robinhood's CEO, Vlad Tenev, gave vague, evasive answers. He kept talking about risk management and protecting customers, but couldn't explain why protecting customers meant blocking them from buying a stock that they wanted to own. The whole thing laid bare the hypocrisy of the system. When hedge funds make risky bets and lose, they get bailed out. When retail investors make risky bets and win, the rules get changed in the middle of the game. So what happened after the dust settled? Melvin Capital, the hedge fund that took the biggest hit, never fully recovered. Despite the $2.75 billion bailout, its reputation was damaged beyond repair. In 2022, Melvin officially shut down. A firm that once managed billions, gone. Robinhood, the app that promised to democratize finance, faced massive backlash. Lawsuits were filed. Trust was broken. The company eventually went public, but its brand never fully bounced back. Many retail traders abandoned it, realizing the platform that was supposed to empower them had pulled the rug out when it mattered most. So, what happened to Keith Gill, aka Roaring Kitty? He disappeared from the internet for a while, but not before testifying in front of Congress. He kept things simple. "I like the stock," he said. No pump and dump, no manipulation, just one guy who believed in a company and put his money where his mouth was. He walked away wealthy, but he wasn't the real story. But maybe the biggest change wasn't the money, it was the awareness. Millions of people saw how Wall Street really works, how trading apps make money by selling your data, how hedge funds can take wild risks and still get bailed out, how when regular people finally win, the rules get changed. The GameStop saga wasn't just about a stock, it was about power, who gets to win, who gets protected, and who the game is really rigged for. For once, the internet fought back and made Wall Street blink. This is the Wall Street Files. Subscribe if you want documented case files on how Wall Street really operates, because this wasn't a one-time event. It's the system repeating itself.